Welcome back. You're watching our special show, Samvat 2070. I've been in conversation with Manish Chokhani, Ramesh Damani and Nirmal Jain. Nirmal, how do you approach it? Do you just say, let the macro resolve itself, let the reset happen when it will? I don't want to miss all the laughs along the way. Participate, but participate with an eye on what's going on around you?
I would say so, because it's very difficult to forecast when this will happen. 5 years ago also, when the crisis happened, the root cause was easy money. And funnily, the remedy they found is also easy money, and it worked. I mean, so if you try to be sane in an insane world, I mean, you may yourself become an insane. So I think rather than finding the point at which the entire thing will blow up or will culminate into a crisis, which, we have to take one day at a time or maybe a few months at a time and just move on. So the day of reckoning may not happen in 2014, may not happen in 2015, it will happen one day. But say it happens in 2018 or 2020, and so you don't want to miss all the laughs along the way. I mean, it doesn't work like that.
Ramesh, how do you play it now? I mean, for a lot of people, the question is, they've sat out for nearly 5 years. At this point, at a new high, to walk in requires a little bit of gumption. What would you suggest to people who are watching you today?
Cash is not going to be king. Cash is king in a deflationary environment. If anything will lead to inflation. And I think, suppose you had kept in cash 1 year back, in terms of your global purchasing power in the world, you've lost money because the rupee has depreciated so much. So you have to get into equities. You have actually no choice in this country. You have to be in equities, sustainable deal, great business, don't expect great returns. But if you want to even protect where you are, if you want to even run the treadmill, I don't see any choice here. What are you going to do? Get back into real estate at hugely inflated prices? Get into gold, which the finance minister is going to personally put you on his enemies list? Equities is probably a good place to be in. And the technical evidence suggests that whether it's a new high or whether it's 22,000 tomorrow, the market wants to go higher. The path of least resistance, as we call it at the Loud Street, is higher. Will it be a zigzag? Always is. I mean, that's always part of the course. But you can have sat through the last 5 years and made a ton of money in a Hero, Honda, ITC, Lever, whatever. So you just have to learn to take those lumps. But you have no choice. I mean, if you're an Indian investor, putting into fixed deposits with 9% inflation rate doesn't make any sense to me. And there are no other asset classes that are widely available. So equity is the way to go.
Would you change your horses, though, this time around? Because the game has been unipolar for a while. That trio of IT, FMCG, pharma, to a limited extent, autos and telecom recently. Is it time to change it around and take more risk, or do you think that's not prudent?
I look at the mid-cap space. That's where I make my bread and butter for a living. So I look at them and say there are great values out there. So I would look at that sector. I mean, as long as I can find a great business, I'm willing to partake with poor liquidity, lack of FI buying, going through all that, because I've stuck through the market for 30 years and I try not to let events phase me, like liquidity or FI participation. So I would do that. But I think the leadership of the market still rests in the three sectors that you mentioned. So if you're a serious financial investor, you need to put money into those kind of sectors only.
What do you think, Nirmal? Time to change around the portfolio composition a bit, or stay with the tried and tested blue chips which have been outperforming?
So I think bulk of your portfolio can still be in pharma and IT, but you can also take some exposure to rural theme, which is like companies like agrochemical. Monsoon has been very good, seeds, tractors. And also I would say that one should look for opportunity to get into auto and cement sectors, because whenever the sentiment turns around, which I am very optimistic, say the elections may happen in March or somewhere between March and May. So the time is not too far. So I think these are the sectors that can be the first ones to rally. And the beta is higher here. So, there will be over ownership in stocks of pharma and IT and FMCG. So obviously the fund houses will try and diversify their portfolio. So I would say at this point in time, I'll try and, for a long time we have been saying that pharma, FMCG and IT, these are the sectors that your equity portfolio should be, but now the time has come to diversify a bit and say at least 30-40% of your equity portfolio should be in these slightly higher risk, the way they are perceived today, sectors.
Manish, what are the chances that we could be headed into another bubble globally? I mean, we saw one in 2007. Do you think this has the shape of building up into another bubble, which has tactical and structural ramifications?
I think, to be honest, is the first time I know that the central banks themselves are interested in creating a bubble. Because if you lift asset prices, you'll eventually get consumption going, at least in the developed world. And when I see composition of the market, while not disagreeing, the reality is FMCG last Diwali to now hasn't actually done anything extraordinary. It's been pharma and IT, which is really led by the rupee depreciation. and the consumer play moved to telecom and auto and media. The best performing media stock I think last year was PVR, when they started consolidating the multiplexes. So the consumer play is surely going to play out in the world, and especially in India, because all said and done we will keep having unit value growth. I think the other end, if and when this world blows up, is where you have hard assets which are hard to replicate. So whether it's a port or whether it's a power plant or whether it's a hotel, these things are not going to be easy to build again, and they will have great amount of value. Like when I think back to 25 years ago, you built a cement plant for 65 crores for 1 million tons, and it costs you 750 crores today. So even if you didn't produce anything for 20 years, you could still sell the plant provided it was operational. So you're heading into that sort of environment where you'll get the what I call pricing power stalwarts, which keep doing well, and at the other end, those which are in the sort of awful category today, they have a slight rate of change, like you saw in telecom, slight rate of change in regulatory environment and competitive environment, and their stocks have all been on a tear. I suspect something like that is due to happen on the other side.
Ramesh, would you disagree with that in principle, or just because your DNA is equity and therefore you cannot bring yourself to being a fixed income investor?
No, in principle and practice, I think it's harakiri basically. If this is a young country, and I'm talking to the young country, I'm not talking to the person at 55 who wants to protect his capital for his retirement years, that makes sensible. But if you're a young person in India and you're happy at 10%, you're not going to get anywhere in life, my friend. I mean, a ship is very safe in harbor, Udayan, as they say, but it's designed to take on the high seas. That's the same true of your capital. Yeah, you might protect yourself at 8% in a fixed deposit or a tax-free bond, but you're never going to get anywhere in life with inflation running at 9%. So you need to go out and find the great businesses. You need to go and make friends with brokers who recommend those kind of stocks. It's not easy, but making money is never easy, and equity markets give you that opportunity to transform your family wealth over a generation, over 10 years, over 15 years. And the long-term compounding rate of the Sensex is about 14-15%, which is fabulous. Plus, if you go back and study the reports that CLSA have come out with, India over the last 10 years, 20 years, dollar-denominated returns, okay? Yeah. The best performing stocks in the Asia-Pacific region are in India. 10 out of 20 are in India. They're in tech, they're in pharma, they're multiplicity of sectors. So, I don't think you should, ignore the forest for the trees. It gives you some level of comfort when the market's down 300 points that your money is safe. But I think at the end of 10 years, you'll feel a lot poorer than you'll feel at the end of, say, 6 months. So strongly suggest that if you're young, which most of us are in India, this is a young country, you need to go out. And it's so attractive to invest in equities in India. I mean, the point I never get tired of telling, dividends are tax-free in India. Capital gains are tax-free in India. You're taxed 30% of the fixed deposit. Why would you put your money there when if you're young? Makes no sense to me.
Sure. At this point, we'll take a quick break. We are back with our special show, Somewhat 2070.